Welcome back. In this lesson, we'll learn the various approaches to value private companies, and also the considerations in selecting the more appropriate approach. We'll also learn how to estimate normalized earnings and cash flow for valuation purposes. Let's jump in. Over the next few lessons, you'll learn the three major approaches to private company valuation. They are the income approach, which values a firm as the present value of its expected future income; the market approach, which values a firm using the price multiples based on recent sales of comparable companies; and the asset-based approach, which values a firm based on its assets minus its liabilities. You probably find these definitions similar to the valuation models for public companies, which you've learnt. In the public equity world, the income approach is known as discounted cash flow or free cash flow valuation, and the market approach is similar to market-based valuation, like using price multiples. Despite some similarities, there are major differences and adjustments you need to make, which you'll learn in the following lessons. The market approach is a form of relative valuation model, while the income and asset-based approach are termed absolute valuation models. The selection of an appropriate valuation approach depends on some key factors, one of which is the firm's life cycle stage. Early in its life, a firm's future cash flows may be subject to so much uncertainty that an asset-based approach would be most appropriate. As the firm moves to a high growth phase with steady income, it might be appropriately valued using an income approach, in particular, the free cash flow valuation model. A mature firm might be more appropriately valued using the market approach, as there would be several comparable transactions as a benchmark. When using relative valuation approaches like the market approach, it's important to consider the size of the firm. For example, price multiples from large public firms should not be used to value a small private firm unless the risk and growth prospects of the firms are similar. Another important consideration in the valuation of private companies is the segregation of operating and non-operating assets. Non-operating assets are those that are not crucial to the firm's primary operations and focus. This mainly includes excess cash and investment accounts. It may be warranted to value the two different types of assets separately based on different discount rates and sum them up to get the value of the firm. Before we proceed with the valuation models, let us first learn some analyst estimations and adjustments that may be required when valuing private companies. First, normalized earnings estimation. In the context of private company valuation, normalized earnings refer to earnings if the firm were acquired. This is very different from the other definition that we've learnt. In the context of price multiples, normalized earnings refer to earnings in the middle of the business cycle. Do note the differences in definitions. In order to calculate normalized earnings, the guiding principle is to identify items on the income statement that will likely be significantly different after the company is acquired and make necessary adjustments. There are a few key areas the analyst should look at. For some private companies, there may be discretionary one-off expenses that are added by the owners to reduce taxable income. In general, exclude such non-recurring and unusual items from normalized earnings. Also, some of the firm's operating expenses may be inflated, again to reduce taxable income. Such expenses can come in the form of excessively high owner compensation or personal expenses charged to the firm. This often comes in the form of personal trip expenses, personal residence expenses, and company-provided life insurance. Such inflated expenses are potentially larger when the owner's family members have connections to the firm. If the firm owns real estate, some analysts separate the real estate from the operating company. This separation consists of removing any revenues and expenses associated with the real estate from the income statement. Depreciation expense on the real estate should also be removed. If the company is using the property in its business operations, adding a market rental charge for the use of the property would produce a more accurate estimate of the earnings of the business operations. The real estate should be valued separately as a non-operating asset based on a different valuation model and discount rate that's more in line with the risk level of the asset, and added to the final valuation of the private company. And finally, in the case of a strategic acquisition, the analyst may want to make adjustments for expected synergies from merging with the acquirer. Such synergy can be incorporated as a reduction in operating costs. For financial or non-strategic investments, no synergy is expected, so no such adjustments are required. So based on a pre-adjusted EBIT of $15 million, the normalized EBIT after adjustments should be $34.5 million. In addition to the various adjustments that are specific to private companies, other adjustments that are common to both private and public companies, like adjustments for differences in depreciation and inventory methods, should also be considered. And lastly, analysts also need to take note of whether the financial statements are audited or merely reviewed statements. Reviewed financial statements undergo less scrutiny than audited statements, so analysts should take closer examination and make more adjustments if required. One step lower are compiled financial statements, which are not accompanied by an auditor's opinion, so even more scrutiny by the analyst may be required. With all that, let's work on an example. Morgan Textiles is a family-owned business that may be potentially acquired by its competitor, Trillion Textiles. Morgan reported an operating income of $12 million in its most recent annual report. The valuator uncovered the following information about Morgan Textiles. The CEO's compensation was $1.8 million. CEOs of textile companies of similar size have an average compensation of $1 million. Morgan leases a bungalow for $600,000 per year for family use. The amount is classified as SG&A expense. Morgan fully owns a $5 million warehouse which is only 70% utilized by the company. The other 30% capacity is leased out for a rental income of $300,000 per year. The warehouse has an annual operating expense of $100,000 and depreciation expense of $250,000. Based on all this information, determine the appropriate adjustments to the income statement and calculate the firm's normalized operating income. Pause the video now and work out your answer. And we're back. Let's go through the adjustments line by line. For point A, CEO's compensation is $800,000 above the market average, so we adjust SG&A lower by this amount. For point B, the use of the bungalow is clearly non-operational. The $600,000 lease expense should be removed from SG&A. Point C is the more complicated part. As mentioned earlier, it's good practice to separate real estate as a non-operating asset, so any income or expenses related to the warehouse should be removed. We are told the rental income of $300,000 is classified under other income. As this is after operating income, this adjustment should not affect operating income. Next, we remove the $100,000 operating expense from SG&A and $250,000 depreciation expense. In place of all these, we should book a leasing cost of the warehouse space based on market rates. For this case, we book $700,000 leasing cost for 70% of the warehouse based on a market lease price of $1 million for the entire warehouse. In the absence of other data, this $1 million market price is based on the $300,000 rental income from leasing out 30% of the warehouse. So, total up all the adjustments for SG&A and depreciation, we get this adjusted income statement. The normalized operating income is therefore $13.05 million. Still on the same example, Trillion Textiles estimates that Morgan's SG&A expenses can be further trimmed by 20% after the merger due to synergistic savings from combined operations. Calculate the normalized operating income after taking into account the expected synergies from the merger. Pause the video now and work out your answer. And we're back. This should be pretty straightforward. Reduce the adjusted SG&A by 20%, we get $28.16 million. The normalized operating income after incorporating synergies is therefore $20.09 million. Another form of adjustment for private company valuation is in the area of free cash flow. The calculations and adjustments for FCFF and FCFE here are similar to those in our previous coverage, so do revise the topic on free cash flow valuation if you need to refresh your memory. FCFF is attributable to both debt holders and shareholders, while FCFE is only attributable to shareholders. The appropriate discount rate for FCFF is the firm's WACC, but for FCFE, the appropriate discount rate is the cost of equity or the required return on equity. FCFF is usually more appropriate when significant changes in the firm's capital structure are anticipated after the acquisition. The reasoning is that the WACC is less sensitive to leverage changes than the cost of equity. Calculating the FCFF or FCFE for some private firms can be particularly challenging, given uncertain future cash flows and figures that are often generated using the current owner's input. The analyst should be aware of the potential bias in management estimates. For example, management may overstate the value of goodwill impairment or understate future capital needs. Another aspect of cash flow estimation involves adjustments for controlling and non-controlling equity interests. When there is significant uncertainty about a private company's future operations, the analyst should examine several scenarios when estimating future cash flows. For development stage firms, scenarios could include an IPO, bankruptcy, or continued private operation. For a mature firm, scenarios might include different ranges of cash flows based on different assumed growth rates. For each scenario, the analyst must assign a discount rate and probability based on the scenario's risk and probability of occurring. A firm value for each scenario is estimated, and a weighted average of these values is used to estimate firm value. And let's conclude with some practice. Morgan's capital structure is expected to change significantly after the merger with Trillion. The valuator also made the following assumptions. Based on these assumptions, calculate an appropriate pro forma EBIT for the next year and estimate an appropriate free cash flow measure for valuation. Pause the video now and work out your answer. And we're back. Let's first work out the pro forma income statement for the next year. Revenue is a 5% increase from the current year, and given 50% gross margin, we have equal cost of goods sold and gross income. SG&A is an increase of 3% from the previous year, and depreciation is 9% of sales. Total up, we get a pro forma EBIT of $26.96 million. We're told the capital structure is likely to change significantly, so FCFF is the more appropriate measure for valuation. And if you can recall, the FCFF is the after-tax EBIT plus depreciation minus fixed capital investments minus working capital investments. Let's first compute the fixed capital investments, which covers the depreciation, and another 4% on the increase in sales to fund company expansion. We get $12.545 million. And working capital investments is 10% of the increase in sales. That works out to $650,000. So we plug all the appropriate figures in, and we get a pro forma FCFF of $17.962 million. And that concludes this overview on the approaches to private company valuation. In our next lesson, we start with the first approach, that is the income approach.